Hi, my name is Ujat and welcome to the show where we're going to discuss another tax saving tip. We're going to showcase how you can save 45% on your tax outflow in just a week's time. This involves your capital gains tax, long-term capital gains tax on your debt funds. Let's take a look. So the gains from debt mutual funds or hybrid debt oriented mutual funds qualify to be long-term capital gains only if you have held that mutual fund for more than 3 years. If you have held for more than 3 years, you can take advantage of the indexation benefits, which we're going to talk about in just a minute. After considering the indexation benefits, the net profit, net taxable profit is taxed at 20% with a 12% surcharge and a 4% cess. So the net taxation is about 23.296%. Now let's look at what is indexation, what are the benefits, and how do we calculate this benefit. Indexation is a methodology by which you can protect the returns from the impact of inflation. As you know, India's inflation is around 5 to 6%, and this impacts the true returns, the true value creation, the true wealth creation over time. So in order to negate or in order to reduce the impact of inflation, we are going to increase the purchase price of our asset year over year to calculate our profits. Since we are increasing the purchase price as inflation is on the positive side, our net profit, our taxable profit reduces, thereby reducing our tax outflow. If we reduce the tax outflow, we get to keep significant portion of our profits. This indexation benefit is provided only for debt funds or hybrid debt funds after a holding period of 3 years. In fact, it is the indexation benefit that makes these debt funds or the hybrid debt funds a better alternative or a more efficient alternative to fixed deposits. Fixed deposits, irrespective of their time duration, do not get the indexation benefit. Now let's look at how do we adjust or how do we increase our purchase price to account for inflation. RBI every year comes up with a cost inflation index which accounts for the inflation in that particular year. Since the inflation number is positive year over year, this cost inflation index only increases. So in order to find the indexed or adjusted purchase price, we're going to take our actual purchase price, multiply it by our cost inflation index in the year of sale of our asset, and divide it by cost inflation index in the year of purchase. As we spoke earlier, the cost inflation index in the year of sale is going to be higher than the cost inflation index in the year of purchase. Remember, there's a 3-year gap between our purchase year as well as our year of sale. So as a result of which, the indexed purchase price is going to be significantly higher than our cost of purchase, thereby reducing our taxable profits and thereby lowering our tax outflow. This is the benefit of indexation. Now let's get to the most important part of the discussion. How do we save 45% on our tax outflow? Let us quickly assume that we made an investment of about 5 lakhs in a debt fund about 3 years back. The CAGR on this fund is about 8%. So the value of this fund as of today should be around about 6,30,000 rupees. The cost inflation index in 2018-19, that's our purchase year, is 280, and the CII for the current financial year, which is 21-22, is 317. Both these numbers have already been published by RBI. The cost inflation index for 22-23 is not yet published, but I expect that number to be around 333 based on the data, based on the inflation projection for the next fiscal year. Now let's look at our calculation of the purchase cost, the index purchase cost, the capital gains, and the tax outflow if we liquidate this debt fund on or before 31st March, and if we liquidate this debt fund on or after 1st April. If we liquidate before 31st March, the indexed purchase price, purchase cost is about 5,66,000. So our capital gains, that's the taxable capital gains, is 63,000 or 64,000 rupees. And the tax on this capital gains is about 15,000 rupees. However, if we liquidate this debt fund on or after April 1st, the CII number that is considered to calculate our indexed purchase cost is 333 and not 317. 333 is the expected CII in the next fiscal year and 317 is the CII for the current fiscal year. After April 1st, we move into the next fiscal year. So the CII that we need to consider for index purchase cost is 333 and not 317. As a result of this, our index purchase cost, if we liquidate after April 1st, would be close to 5,95,000 instead of just 5,66,000. The taxable capital gains has significantly reduced from 64,000 rupees to just 35,000 rupees if we liquidate after April 1st. So our tax outflow is reduced to just 8,000 rupees if we wait just for 1 week. So in effect, we are saving about 45% by just hanging on to our debt funds for another week. Irrespective of our investment value, whether it is 5 lakh, 1 lakh or 10 lakh or 1 crore, the tax saving would still be 45% if we liquidate this debt fund after this financial year. So this also brings another point to focus. The best time to invest in any debt fund is towards the financial year end. I hope you liked what you watched, and I hope you're also taking advantage of all the tax saving tidbits that we are offering as we move into the taxation season. Do subscribe to our channel to get more of these tidbits, tax saving tidbits, and do share this video so that more people can benefit from it. Thank you.